Hello, welcome to Trading Club Q7. I'm your lead educator, and today we're going to talk about a critical mindset shift that's essential for trading success. It's a concept that, when mastered, can reduce stress, increase confidence, and ultimately boost our trading returns. But before we dive in, let me ask you this: have you ever felt frustrated or anxious while trading, wondering why your predictions didn't match the market's outcome? Well, you're not alone. Many traders struggle with the idea of consistently predicting market moves. But here's the thing: trading isn't about making perfect predictions, it's about working with probabilities. And that's what we're going to explore today. So, what is the mindset shift from prediction to probability? In simple terms, it means moving from thinking that we can accurately forecast the market's future to understanding the likelihood of different outcomes. Think of it like flipping a coin. You can't predict which side will land face up, but you can understand the probability of heads versus tails. It's a subtle but crucial difference. Imagine you're about to enter a long position in a stock. If you think of it as predicting the stock will go up, you might get caught off guard if it suddenly plunges downward. But if you focus on the probabilities, you'll be more prepared for different scenarios. You might say to yourself, I think there's a 60 chance the stock will go up, a 20 chance it will go sideways, and a 20 chance it will go down. That's a more realistic and nuanced approach. But let's take this a step further. What happens when you're considering multiple factors that can influence the stock's price? For example, you might be looking at a stock that has been trending upward due to strong earnings reports. However, you also know that there's a chance of an economic downturn that could impact the stock's price. In this case, your probabilities might look like this: a 40 chance of continued growth due to strong earnings, a 30 chance of a correction due to the economic downturn, and a 30 chance of a surprise announcement from the company that could impact the stock price. By considering multiple factors and breaking down the potential outcomes into probabilities, you can develop a more comprehensive and realistic trading plan. Now, let's look at an example where many traders go wrong. Imagine you're a beginner trader who's new to the market, and you're eager to make a profit. You spot a stock that's trending upward, and thinks to yourself, this stock is going to moon. But then, something unexpected happens, and the stock plummets downward. You might feel frustrated, angry, or disappointed because your prediction didn't come true. But here's the thing: that's not a prediction failure, that's a probability mismatch. You see, as a trader, you need to understand that the market is inherently unpredictable, and there's always a chance of unexpected events that can impact the price of a stock. One of the common mistakes beginners make is getting caught up in predicting a single outcome. They might focus on a particular trend or pattern, and when it doesn't materialize, they feel frustrated or confused. To avoid this, remember that trading involves uncertainty. The more you can understand and work with probabilities, the more prepared you'll be for different scenarios. Another common mistake is overconfidence. When you're trading, it's easy to get caught up in the thrill of the market and think you're right all the time. But the truth is, even experienced traders can be wrong sometimes. To avoid this, make sure to regularly review your trades and assess what went wrong. This will help you identify areas for improvement and develop a more balanced approach to trading. So, here's a practical exercise for you to try. Take a piece of paper or open a demo chart and think about a stock or asset you're interested in. Now, try to break down the potential outcomes into probabilities, just like we did in the example. What's the likelihood of a price increase, a correction, or a reversal? Be realistic, and don't worry about being exact. The goal is to get comfortable with the concept of probabilities. As an added challenge, let's try to break down the potential outcomes into 3 categories: high impact, medium impact, and low impact. For example, A high-impact event might be a surprise announcement from the company that could impact the stock price. A medium-impact event might be a change in market trends that could influence the stock's price. And a low-impact event might be a minor news announcement that won't have a significant effect on the stock price. Take a few minutes to think about a stock or asset you're interested in and try to break down the potential outcomes into probabilities and categories. Remember, the goal is to develop a more comprehensive and realistic trading plan that takes into account the inherent uncertainty of the market. To recap, the mindset shift from